The market's been pretty bearish over the last couple of weeks with the government shutdown, geopolitical issues, and tariffs. It's been a crazy ride. We also had some earnings calls, and one in particular from Meta that really shook things up, that caused the market to pull back quite a bit. Almost every stock dropped. But this week, a lot of things could change. However, this week, things might shift, especially with recent updates about a trade agreement that was made over the weekend. So, if you're wondering what your favorite stocks are gonna do this week, and what the market might look like, then this is the video for you. Today, we're gonna talk about the VIX. I'm going to explain volatility, and let you know which stocks are likely to run this week, and how the market is likely to play out. So, strap in, stay tuned, and don't skip any part of this video, because I'm going to share with you a really powerful tip and strategy that can tell you almost exactly what's going to happen tomorrow in the market, and you can start using it tonight. So, let's dive into today's video. The government shutdown is still ongoing, and as we approach November 4th, it will become the longest shutdown in history, surpassing the previous record of 35 days from the earlier administration. However, the market's likely to be a little jumpy this week, because if the government doesn't reopen, that's going to have some negative effects on the stock market. But that's not the main factor. The real issue here is the tariffs with China. As you saw, when the government first shut down, VIX didn't really spike that much, and when it did, it came right back down. Overall, the market performed pretty well, especially the week after. The real turbulence came from the trade tensions and rising conflicts. Historically, during government shutdowns, the stock market tends to recover quickly and perform well afterward, so I expect that trend to continue. The main pressure on the market has been trade-related issues, but with the latest updates, things are starting to look much better. Over the weekend, leaders reached an agreement to ease trade tensions, including tariff reductions and a pause on new restrictions for key industrial materials. The agreement also includes the return of major agricultural purchases, and helps prevent a potential escalation in trade measures. The temporary trade pause is expected to last about a year, with certain import duties remaining in place for specific regulated materials. The overall tariff rate will be reduced from 57% to 47%, including earlier trade adjustments, and the 10% rate introduced in April. This outcome is better than expected, and is likely to have a positive impact on the market. In this video, I'm going to show you how to gauge what's almost guaranteed to happen tomorrow. I'll show you how you can predict the market 12 hours in advance. But first, let's take a look at the VIX. When we look at the VIX, historically, we see that every few months, volatility spikes pretty big. From this point, we had a 3-year spike before the next big one, and after that, another spike. So, if the government shutdown is resolved in the next couple of weeks, and the tariff talks continue improving like they are, based on the historical trends, we're unlikely to see another big spike in the VIX until somewhere between June of 2027 and the end of 2027. This could be a good year and a half of solid market trends. Looking at history, about every 2 to 3 years, we see a big spike, and every 2 to 3 months, a smaller one. As you can see, the VIX has had a lot of small spikes, but overall, it's been relatively low. If the government shutdown is resolved and tariff talks improve, we'll likely see the VIX gradually drop. So, if you look at the chart, you will see that the VIX has been trending down. We might see a little spike this week or next, but overall, expect the VIX to trend lower, and then we might get another spike sometime around March or April of 2026. The exact timing, not sure, but that's the trend. Based on the VIX historical movement, if the VIX is between 18 to 20, that's considered a stable, strong market, but slightly elevated if it's below 18. That's very low VIX, meaning the market is extremely stable. Between 20 to 25, it's high volatility, and over 25 is extreme volatility. Over 30, it's insane volatility. You need to understand that when you're selling options below 18 doesn't make a lot of sense. You could sell a 35 delta option on Tesla a week out and make $400. But if the VIX is above 20, That same option could make you $800 or more. If the VIX goes up to 25 or 30, you could make $1, 500 to $1, 800. So, the best time to sell options is when the VIX is between 18 to 20, or 20 to 25 if a stock is fundamentally strong and it's just down because the VIX is up. It's the perfect time to buy the stock and collect the premium while volatility is high. When the VIX drops and the stock rallies, you can take the profits. Generally speaking, when the VIX is below 18, it's an opportunity to buy options, and when it's between 18 to 20, it's a little of both. Once it goes above 20, it's better to sell options. However, you can still buy options if you know that implied volatility, IV, will increase and that could raise the value of your options. This is how big institutions make money. They sell options when IV is high, and then when the stock moves just a little, the options value crashes. IV crushes a major way they profit. So learn how it works. So, I hope these strategies help you better predict and navigate the market. That's it for today's content. See you next time.